Welcome to Markets in a Minute. My name is Austin Duke. I am financial advisor and chief investment officer for Diamondback Financial Services. We are an investment advisory firm focusing on clients who recognize the need for solid investment advice, who don't want to invest on their own, but still want to be educated through the process. This is the Monday, April 14th, 2025 edition. Let's get started. We'll start by looking at the stock market as measured by the S&P 500. This is an index of the 500 largest companies in America. Stocks will go up and down on a daily basis for a variety of reasons. Our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. So I also just got back from Disneyland with my family. We were there in the first week of the past 2 weeks, and it was stressful to say the least. I mean, I'm already on vacation with my family, but then with everything else going on with the stock market, it was a challenging time. But I'm going to try to be a little cute and add a little bit of Disneyland terminology to what we saw for the last 2 weeks to make it a little bit more fun. We'll just say that this was like the Inside Out emotional whirlwind ride or Mr. Toad's Wild Ride. Um, just because it was crazy. Maybe it was like the Incredicoaster. I don't know. Um, but basically, we started off, we knew a tariff announcement was coming. President Trump called it Liberation Day, right? Market seemed to be doing okay. Market closed on the second, and then President Trump had his tariff announcement, 10% across the board, and then he pulls out this chart showing reciprocal tariffs for every country, and they're big. They're big numbers. So then we ended up having some kind of a Guardians of the Galaxy or Tower of Terror type moment where the market just dropped and dropped and dropped, almost like a free fall. So of course, I'm driving to California on this day. Things seem to be doing just fine. I'm walking through Sleeping Beauty's castle on the third, knowing that the market's down. I think that was about 3%. Friday it was down another 5%. So, Toy Story Midway Mania going on while the market's dropping on the fourth. So, um, we opened up on Monday, the seventh, in a technical bear market, 20% correction from the highs that we had in February. If we had closed down at this level, it would have been a 20% move on the books. But I came into the office and my Snow White's enchanted wish was for clients to stay invested, not panic sell. We've seen this before where people will want to sell and it's actually like the worst time possible, and then they miss a rally that the best days tend to come on the heels of bad days. And it's when you feel like I can't take this anymore, that's the moment where you got to ride through it and uh, and then you'll be rewarded. So we were fortunate to send out that email, and then kind of like a rise of the resistance, there was a rumor floated that President Trump was going to delay the tariffs by 90 days, and so the market reacted positively. And then it was debunked as a rumor, and then the market came back down, but it never went all the way back down to where we had opened. So we came back above that 20% mark. Um, Tuesday was another kind of bad day. I think again, like we all expected that this was a negotiating tactic, that President Trump was going to back off or he was going to reduce it. He was going to give some kind of reprieve to those tariffs, and we weren't getting it. So when I woke up on Wednesday morning, the ninth, and it hadn't been rescinded or anything, I was convinced that this was it, that this was the new regime, that he wasn't going to back down, and we now finally had the clarity that we needed to then move forward, and we could kind of adjust to the new tariff levels, et cetera. So I think the market responded relatively calmly initially on the ninth, and then around the middle of the day, like Mike and Sully to the rescue, the Monsters Inc. ride. We then go soaring over California, and we ended up posting a 10% gain in the market on the ninth when President Trump delayed the tariffs by 90 days. So It was interesting to say the least. That's a $5 trillion move in the market on the 9th. So a significant amount of buying that occurred. We're still digesting economic data. We're still trying to figure out like the tariffs are still there, right? Like we know that there's going to be tariffs of some kind after this 90 days is over. So this hasn't really resolved anything. We're hopeful that President Trump makes deals and we get this resolved before the 90 days is over. But for now, we are just going to take it for what it is. And we would like to hope that this was the bottom of this downturn, that we'll be back into an uptrend. But because we still have this 90-day uncertainty, we're not going all in, at least at this point. We're still going to be treading lightly and being judicious about where we invest and how much. Next, we'll look at interest rates as measured by bonds issued through the U.S. Treasury Department. We believe that interest rates are the preeminent measure of investment risk. Interest rates are factored into every valuation calculation, including stock valuations. Rates will move up and down on a daily basis for a variety of reasons, and our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. So on this chart again, we've got interest rates listed over here on the y-axis. We've got maturity lengths listed on the x-axis from 1 month all the way out to 30 years. So each of these dots is an interest rate with a corresponding maturity length. The green line is where we ended on April 12th, and the brown line is where we were 2 weeks ago. Not a lot of change on the short end of the interest rate curve, but here in the medium to long-term end, we saw a significant increase in interest rates over the past 2 weeks. It's been pretty spectacular. The fixed income, the bond market is significantly larger than our stock market. So when we see these kinds of interest rate moves, it's very significant. It's even more significant than the impact that we see on the stock market. We're obsessed with the stock market. We watch that on a daily basis, but interest rates really have a lot more impact on just overall financial health of our economy. So when we see increase in volatility and a lot of moves up and down, it becomes more worrisome. So there's a lot of speculation that President Trump was noticing some of the stress in the bond market, which is why he pulled back on the tariffs. It had less to do with what was happening in the stock market. So. But this is the chart of the 10-year U.S. Treasury. This rate is most closely tied to mortgage rates. So when this rate goes down, that's when we tend to see people applying for mortgages. We did see a 20% increase in mortgage applications as the rate came down here close to 4%. But then going from 4% to 4.5% in a week is alarming. That is a significant move. It's hard to contextualize the impact that has on the overall financial markets, but that's quite the move. But it kind of reminds me of the Smuggler's Run or the Star Tours, right? Like you go down, you have to get something, and then you take off. You're going into hyperspeed or warp speed or whatever whatever it is. But it's a fun ride when you're getting out of there and going through light speed. So anyway, but this was significant. I wanted to point this out. I guess where we think we're going from here is continuing to go up unless we can start getting some resolution to economic policy. Maybe the Federal Reserve steps in and tries to do something with interest rates, or just in general, President Trump is able to make some deals and get some resolution to the tariffs soon. We still think the Federal Reserve is going to cut rates several times this year. We think June will probably still be the first one that they do. That will give them some good length of time to look at economic data and decide that that's going to be a good time to make that move. So that's the current forecast. All right, for our investment expectations and implications portion, we want to take a look at some of the prior 20% plus declines that we've had in history to kind of give us an idea of what we think is going to happen with this downturn that we've had recently. We'll start with the famous crash of '87. This is actually a decline that occurred from August of 1987. We did have the crash in October, but we ended up at a lower point in December. We dropped 33.5% over a period of about 3 months. And then from the bottom back to all-time highs took us about a year and a half. In 2001, this is the dot-com bubble. We went from a high in March of 2000, and it took us about 2 years, 2.5 years to get to the low in October of 2002. We dropped over 49% from top to bottom. But this was painful, right? Like this is a bear market, this is a recession, an extended period of time to get from the top to bottom before you can start that upward trend. And it took us 4.5 years from the bottom in 2002 all the way up to new all-time highs in 2007. And just when we thought that maybe things were getting better, we hit an all-time high, and then the financial crisis comes along. So it takes us about another year and a half from October of 2007 to March of 2009. We drop over 56% from top to bottom. And then from that bottom back to all-time highs, it takes us 4 years. Again, this is painful. This is a bear market. This is a recession, and it takes an extended amount of time to recover from that. Next is going to be what we are referring to. Well, no, this is the COVID-19 pandemic. So again, a little bit different, right? The government decided we're going to shut down the economy, and then the government's going to come to the rescue, right? And then they're going to help bail us out. So we have a very sharp drop, 33.92%. That took 1 month from February of 2020 down to March. And then we were back to all-time highs 5 months later. All right, so a totally different kind of scenario than some of the prior ones that we had, but it still counts as a 20% drop. It still counts as a recession by our National Bureau of Economic Research. So we highlight it. Then we have what we are going to term inflation frustration. Everything else gets a fun name, so we're trying to coin some phrases here. But this was 2022. So we hit a high in January of 2022. It took us 9 months to get down to the bottom of that market, dropped 25.43%. And then we were able to resume that uptrend. And it took us about 1 year, a little over a year, about a year and 3 months to get back to all-time highs. And now we're in what we're calling the tariff tantrum, which started February 19th of 2025 and dropped here 18.9% by April 8th, which, for all intents and purposes is a 20% drop because we did on an intraday basis get 20%, but not by a closing basis. So what we're trying to determine is, are there things that have happened in the past with these 20% declines? Are things broken? Do they need to be fixed? How long is it going to take to fix them? And if we were to make a guess, we'd say that this is probably something that is fixable in a short order. We think that it's still probably going to be many months before we get back to all-time highs. If we take a look at how long the recoveries usually last, they are significantly shorter now than they were back in the 80s and early 2000s. So with the COVID pandemic, with the inflation, interest rate rise of 22, we're looking at 5 months to a year, maybe a little more than a year. Our guess, our opinion is that within 9 to 12 months, we'll be back to all-time highs. The question is, are things gonna break even more than they already have been broken, leading us into an extended decline, leading us into a recession that's gonna take us years to get out of? Or like the COVID pandemic, are we going to be able to have the government come to the rescue? President Trump will make all these deals, and we'll be able to be off to the races again, and maybe recover in 5 months or 6 months, or whatever the case may be. So that's kind of where we're at with how things are shaping up at the moment. Again, we're hopeful that things can get resolved and back to all-time highs before the end of the year or early next year, but we're also trying to be realistic and recognize that there's a lot that needs to happen for that to occur. There are a lot of people now that are calling for a recession. A lot of people say that we're already in a recession. Because of all the uncertainty and businesses not being willing to buy things or hire people because they have no idea what to expect from all of this. There's people suggesting that when the data finally comes out in a month or 2 months or 3 months, that we'll see that we're in a recession. So most of those details are around consumer spending and employment. So those are the things that we're going to be watching closely to determine if we actually get hard data suggesting that we're in a recession or not. The consumer sentiment surveys are very bad. They're saying, the lowest since the 80s, but there is this divergence of actual hard data versus what the consumer sentiment surveys are saying. So our take is that people are watching too much TV. We're seeing that the media is constantly putting the worst case scenarios out there, like this could happen or this may happen, this might happen, and they're all scenarios that are bad and that we're not giving enough on both sides, right? Like, hey, let's talk about like what could be a positive from tariffs, or we're just going to talk about inflation, that it could be inflationary, it could be recessionary. And so we would say if people don't watch as much TV, maybe the sentiment surveys wouldn't be diverging as much as they have been with actual hard data suggesting that our economy is still okay at this point. So, we'll see if that continues. Something to highlight as we have entered first quarter earnings season, we have got the financial companies that are reporting. Consequently, record revenues on trading during the last couple of months has been very lucrative for some of these big banks, which we find very interesting. So, um, we also think that we're going to have fewer companies reporting guidance, 12-month, revenue and earnings guidance like they normally do, just because they don't know what to expect, what they're going to be able to sell, what prices they're going to be able to sell it for, et cetera, with tariff uncertainty. So we feel like it's kind of hard to figure out how we want to invest if even the companies themselves don't know what to expect. So we'll see how that goes. We did get some inflation reports here at the end of the week that were actually better than expected. The Federal Reserve is trying to get the inflation rate down to 2%, and when they get that down, they'll feel more confident that they can continue to cut rates. And so we're hopeful that that is something that happens here by June or by the summer. And then as we were putting all this together, we did see that President Trump allegedly is offering exemptions on some electronics, which we believe could be beneficial to companies like Apple and Nvidia. It could still be speculation. It's not like an official announcement, which we probably maybe will get on Monday. So we're not making any recommendations or anything. We're just recognizing that this tariff situation is continuing to change and unfold on a daily basis. So, we're putting these out every 2 weeks, trying to be as helpful as possible, but it's a fluid situation, and we're doing the best we can to stay on top of it. But finally, the year-end earnings for all the S&P 500 companies are in. We have some clients that like to invest in individual stocks. We're going to be doing some more research. It's going to be a challenge, but we'll do the best we can to figure out what we want to be in our core position for the next 12 months, and we'll keep you posted on that. All right, as a final word, I did not win the NCAA men's basketball bracket challenge. My youngest son, Joey, ended up winning that. He, if you remember, came to work with me about a month ago for career day. He helped me pick a couple stocks for my account. They're doing okay, all things considered. So if he's going to be good with these basketball picks and stock picks, maybe there's a future for him in finance. I don't know. We'll see. But we're also celebrating a 3-year anniversary for Diamondback Financial. Pinocchio's daring journey to leave Edward Jones and go off on my own. And not everybody makes it. So, to make it 3 years, we feel very humbled and blessed, and we recognize that it's the clients that make everything possible. We owe everything to you guys. So, we thank you for your trust. We thank you for sticking with us, especially when the stock market isn't doing fantastic. Thank you for taking our advice and sticking with us. We would prefer that it was like a jungle cruise all the time and always going in a positive direction, but we know that isn't always the case. So I'm trying to think. What else can I do? Haunted mansion. We hope that we don't feel like that the market or that this video has been a haunted mansion. Um, but that it's been somewhat enjoyable, and hope you guys have a good week. We look forward to the next 3 years and everything that it has to offer. We hope that you have a good week and a happy Easter, and we'll see you soon.